Stop thinking of your house as an asset for a moment. What if it's the most expensive liability you will ever carry? Not because you were reckless, not because you overspent, but because the financial structure underneath home ownership has shifted, and most people haven't adjusted. From the outside, everything looks stable. Inside the numbers, something is tightening. If your housing costs exceed 35% of your take-home income, this likely applies to you. You may not feel broke, you may even feel stable, but stability built on thin margin is fragile, and fragility does not announce itself. It reveals itself during stress. For decades, Americans were told buying a house builds wealth. A fixed mortgage, rising property values, and growing wages made the system work. Home ownership aligned with income growth, and for a long time that alignment created stability. Today that formula looks different. Home prices surged faster than wages. Interest rates reset higher. Insurance premiums became volatile. Property taxes climbed alongside valuations. The narrative of stability remained, but the underlying math changed. The mortgage is only one layer of cost. Insurance, taxes, utilities, maintenance, each adds pressure, individually manageable, together overwhelming. What disappears first is not the house, it's the margin. In many states, insurance premiums have increased sharply. Climate exposure and regional risk have recalculated pricing models. For some homeowners, renewal notices now bring double-digit increases. Insurance is required. It cannot be postponed. Scene 7, rising home values often lead to higher property taxes. Appreciation may look like wealth on paper, but taxes are paid in cash. Every year, even if income has not risen proportionally, often lead to higher property taxes. Appreciation may look like wealth on paper, but taxes are paid in cash. Every year, even if income has not risen proportionally. Scene 8. Homes age whether we plan for it or not. Roofs deteriorate, systems fail, repairs arrive without warning. Many households underestimate maintenance costs, and when repairs go on credit, interest multiplies the burden. And being house poor does not mean bankruptcy. It means overcommitment. It means most income flows into housing expenses, savings slow, retirement pauses, flexibility disappears quietly. In rising home values create the illusion of wealth, but equity is not liquid. It cannot pay monthly bills unless borrowed against, and borrowing increases exposure. Ask yourself a direct question. Could you maintain your housing costs for 6 months without income? If the answer is no, your stability depends on uninterrupted earnings. When millions of households operate without margin, economic fragility spreads. As long as employment remains stable, the pressure stays hidden, but layoffs expose thin structures quickly. The mortgage approval is based on ratios, not comfort. Qualification does not guarantee sustainability. What a lender approves may not create long-term stability. Housing is emotional. Larger homes redefine what feels normal. Social comparison influences decisions. Buyers stretch not only for shelter, but for status. The danger is not sudden collapse, it is erosion, savings thin, stress rises, flexibility narrows, all while the house appears stable from the outside. Closing your home was meant to build wealth. For many Americans, it now quietly absorbs it. Wealth is not measured in square footage, it is measured in margin. And the real question is whether your home still allows you to build freedom.